After rapid growth in the late 1990s through the mid-2000s, home prices in the United States have been falling sharply since 2005. This reversal has reinforced the financial crisis in the United States.
The downswing in the U.S. market is the most serious one in the last 60 years. House prices have fallen steeply. One major segment of the housing market, the subprime market, has virtually disappeared. And it's clear that foreclosures have risen quite sharply as well.
What is not so clear is whether prices will drop even further, and by how much. Previous episodes of Housing Market Cycles can shed some light about where we are in the process.
Roller coaster rides in the housing market can be fairly long. When the roller coaster is going up, that takes as long as 6 years, and house prices go up 45%. And then when it starts its descent, that process can take as long as 4 years, and prices fall about 25%. So what we can say is that the U.S. housing market correction, which began all the way back in 2005, is pretty far along, using history as a guide.
After a steady upward climb, home prices are now declining in several advanced economies. This is perhaps not surprising, as home prices in several of these countries were also overvalued.
The housing market roller coaster is descending in those other markets as well. This year, house prices have fallen 5 to 15% in virtually every major advanced economy all across Europe, in Canada, in Australia, New Zealand.
The current financial crisis, coupled with high commodity prices, will likely lead to a slowing of growth in major economies, several of which are either close to recession or experiencing growth far below potential. This hefty combination and the housing downturn in the United States and in some other advanced economies could create a global financial storm.
And what we know from our research is that when recessions coincide with these housing price corrections, the recessions can be more prolonged. So an average recession lasts about a year, but when it coincides with the housing corrections, you have to add on 3 months on top of that. So the recessions are going to be longer and they're going to be much more painful.
And if a recession were to occur in the United States, on top of the housing price correction, the macroeconomic consequences would be magnified.
Unemployment tends to go up more when you have the coincidence of a recession and a housing price correction. So for instance, if you look in the United States, when you have a recession, unemployment in the various regions tends to go up about 2 percentage points. But when you have a housing correction going on at the same time, the impact on unemployment is double. It goes up by 4 percentage points. So it really has the potential for being quite a painful adjustment.